Hello, welcome to this Ned Davis research video where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we will be speaking with NDR's Senior U.S. Economist, Veneta Dimitrova, about the U.S. economic outlook. Veneta, do the indicators reflect a strengthening, slowing, or even a contracting U.S. economy?
Well, thank you, Brian. That is a valid question, right? Given that second quarter real GDP growth in the report yesterday picked up significantly. So average growth in the first half of the year, however, is still much softer than last year and is tracking close to its long-term trend. Look, there is no doubt that peak growth rates in this cycle are behind us. And you don't have to look far for evidence that the economy is on a slowing trajectory. For instance, payrolls growth is still decent, but slower than last year, and it's driven by non-cyclical sectors such as healthcare and the government. There's also continuing jobless claims and the unemployment rate that have edged up. Excess savings have been nearly depleted for consumers, and high financing costs are constraining big ticket purchases. But slower growth doesn't mean recession, right? This is important because equity markets tend to suffer their largest drawdowns when the economy is contracting. We actually expect real GDP to increase about 1.5% to 2% this year, which would be a slowdown from last year and is slightly below trend growth. Yet, the risk of an outright recession in the near term remains pretty low. We have this US Recession Watch report in our service that focuses on 10 key metrics, including housing starts, employment, financial conditions, business and consumer confidence, as well as manufacturing and services PMIs. So although several of these metrics have deteriorated recently, only one has actually passed its recessionary threshold. And typically, when the majority of indicators have turned is when you have to worry about the economy facing a recession. So we're definitely not there yet. The economy is drawing continued strength from favorable financial conditions, positive stock market and housing wealth effects, as well as low debt service burdens for both consumers and businesses. Some of these conditions are reflected in our US economic timing model, which has been in positive territory since December of last year. Its latest reading is actually consistent with moderate economic growth and is further evidence that the risk of recession in the near term remains quite low.
Vanetta, so with the risk of recession remaining low but slowing economic growth, what does that all mean for the inflation outlook in the US?
Well, with aggregate demand holding up reasonably well, we expect only modest disinflation for the rest of this year. We actually project CPI inflation to be between 2.75% and 3.25% at the end of this year, which isn't very far from current levels. Although rents should continue to come down, services inflation, ex energy and shelter, remains quite sticky. It has surely moderated from earlier in the cycle, but it is still running at about double its pre-pandemic rate. And there's a good reason for that, right? It consists mostly of labor-intensive services. So as long as the labor market remains relatively tight, elevated wage pressures will keep that type of inflation from coming off quickly. Additionally, goods deflation has probably run its course, firming global manufacturing activity, normalizing supply chains, lean retail inventories relative to sales, all suggest that the deflation in goods prices that we have been seeing so far this year will likely dissipate. So putting it all together suggests slower disinflation in the coming months. And our inflation timing model is already capturing some of this trend. Its 22 components primarily measure various rates of change in indicators such as commodity and consumer and producer prices, capacity utilization, loan growth as well as interest rates. So the model has picked up so far this year, but remains in the moderate disinflation zone where it has been since May of last year. It implies that the underlying trend is still for continued disinflation, but most likely at a slower pace than we have seen so far in this cycle.
Veneta, based on your economic growth and inflation outlooks, what are your expectations for monetary policy?
In many respects, Brian, the Fed has got the economy right where they wanted. Growth has come down, and so has inflation, and all that without a painful recession. Our outlook is for these soft landing trends to continue for the rest of this year. But inflation is still above the Fed's longer run target of 2%, right? And there is quite a bit of uncertainty about the longer run outlook related to the presidential election, tariffs, taxes, and immigration policy, all of which can be quite inflationary. So the Fed will likely proceed carefully. We don't expect them to cut rates until at least September. And look, there'll be two more CPI reports and two more payrolls reports before the FOMC meeting in September. And if they show continued disinflation in the third quarter and a still healthy labor market, then the Fed should have enough confidence to start easing policy. So 1 or 2 rate cuts are likely on the horizon for this year.
Veneta, thank you for your insights. NDR clients can read Veneta's research notes in her daily economic perspectives and U.S. economic-focused publications. The indicators Veneta and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs and as ETFs. For more information on NDR, we encourage you to visit ndr.com. Also, for those listening in audio-only mode, video versions, including charts of See the Signals, are available by going to info.ndr.com/NDR-signals. Thank you for joining us as we help you to see the signals. So long.